Out. So hi everyone, welcome. This is our GPSA's March Lunch and Learn. We're doing a tax workshop this afternoon. We have Professor Gregory Karas here from the Accounting and Finance Department. Professor Karas did this for us last year, super helpful. So thank you so much for being here. We really appreciate
You're
you.
welcome.
We are recording this meeting, so we will be able to share this with folks later. Harshita is also here from President of GPSA. Is going to monitor the chat. So if you have any questions, feel free to put them in the chat as the presentation goes on, and there'll be time at the end too for that. So, Professor Karas, I'm going to jump it over to you. Again, thank you so much for taking the time to chat with us today. We really appreciate it.
You're welcome. You're welcome. Welcome, everyone. Thanks for being here today. Hope everyone had a nice spring break. Uh, as you know, Dr. Gregory Karas, I am an adjunct professor in the Accounting and Finance Department. I'm also a double alum of Bridgewater State, first when it was a college and then when it was a university. And I've worked in the accounting and finance field for most of my adult life, and I've been preparing taxes for more years than I can count, but somewhere 30 plus. So we're going to talk a little bit today about income taxes. And I know there's a lot to digest when it comes to taxes. So I'm just going to provide a very brief overview of taxes, kind of go through a couple of the common forms that you might encounter if you file taxes. So I'll be bouncing back and forth, bringing some stuff in. Just to give a flavor of what goes behind the computation of income tax and some of the terminology which you may have heard, and give you a little bit better understanding of what it's all about. So the first question is, what is a tax? So when we think of taxes, we typically think about income taxes because that's what we pay every year. We work, we get paid at the end of the year, we fill in a bunch of forms, we send it off. We either have to pay more, hopefully not, and or sometimes we get a little bit back. Okay, but there are different types of taxes that are not tied to income. So what exactly is a tax? A tax, in its simplest form, is just a payment required by a government that is unrelated to any specific benefit or service that's received from the government. So we all have a driver's license. We pay for our driver's license. This is not a tax. However, when we rent a vehicle, if we rent a vehicle, the price that we pay for the cost of renting the vehicle, there's a certain percentage that is included in that cost of the bill that goes to the upkeep of roads. That would be a tax. So we receive some sort of specific benefit from the government. So as we can see, taxes do not just come from income. They're not just from income earned. And when we talk about income taxes, we have deductions and credits when we go through and fill out our income tax return. So we have deductions and credits, and those deductions and credits typically come with limits or thresholds. So in other words, a dollar amount has to be reached. We have to spend so much money in order for a deduction or credit to kick in. The other side of that is once a maximum dollar amount is reached, that deduction or credit is not allowed. So you got to be careful on what we have when you're dealing with deduction and credits. Again, sometimes we have to spend an amount of money in order to get that deduction or credit. Other times, if we earn too much or spend too much, then our credit or deduction is not allowed. So there are some different types of taxes. Again, generally, I'm just going to cover the two basic types, federal and state. Those are the ones that we deal with our income. So we deal with the federal and state taxes. So we know that when we work, our income is taxed at the federal and state levels. Now, if you happen to live in a state that does not tax your income, there are 9. There's Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, so Seattle, and Wyoming. So if you live in any of those states, your income is not taxed. Otherwise, your income is taxed on the federal level as well as the state level. So our income tax, this is money that we earn. When we earn money, now the government wants to know whether we earn our money legally or illegally. The government requires us to report all our income when we file taxes. And you're probably thinking, if I'm earning money illegally, am I really going to tell the government about it? Well, by law, the government wants you to tell them. Okay. Now, the best example I can provide of someone who you may or may not have heard of, Al Capone. Now, Al Capone was a mobster in the early 1900s, and he was involved in bootlegging, racketeering, murder, extortion. I mean, you name it, he did it. But the government was never able to pin any of those crimes on him. He did not go to prison for any of his crimes. What he went to prison for was he did not file income taxes. So he ended up going to prison on 22 counts of tax evasions. That's what sent him to prison. Again, the government wants to know, they don't care how you earn your money, legally or illegal, you got to record it and report it on your income taxes. Okay. So now there is some income that the government does not tax. It's not included in our taxable earned income. And some of that is interest earned from investing in municipal bonds. So if you buy some municipal bonds, any interest you earn on those bonds is not included in your taxable income, as opposed to if you have a savings account or CDs or some other investments that you gain interest on, that interest would be included in your earned income. We also have, if you have your primary home and you sell your primary home, the gain on the sale of that home is not taxable, it's not included in your income up to $250,000. So the first $250,000 gain on the sale of your primary home is not included in taxes. Now, if you're married, that's double, it's $500,000. So anything above and beyond those thresholds now has to be included in your earned income. Okay. Unemployment tax, we pay unemployment tax that comes out of our pay that provides payments of unemployment compensation to workers who have lost their jobs. Excise taxes are placed on goods or services like fuel or tobacco, alcohol, and they're paid by the business. And then in turn, the business then passes that cost on to us, the consumer. Transfer tax. This is a tax that's levied on the fair market value of wealth transfers when we die or if we give money by gifts. Okay, now the IRS does allow each individual to give a gift of $18,000 to someone without having to file a Form 709 to disclose that gift. If we gift anything above that dollar amount, the IRS, we're going to have to pay taxes on it. It's a gift tax. Now, if you're married, that's double. It goes from $18,000 to $36,000. Also, we can give $18,000 to multiple individuals without having to file a Form 709. So we're not relegated to just one $18,000 gift. We can give an $18,000 gift to 10 people. As long as we don't go above that $18,000 threshold per person, we do not have to file a Form 709 to disclose that gift. Okay, so again, I think you can start to see now the flavor where we have thresholds that we have to meet, or once we meet them, the deduction or the credit is disallowed. Now on the state side, we also have income tax levied on earnings, and that depends on the state that you live in. Sales and use tax are levied on the retail sales of goods and services. Now, Massachusetts, you live here in Massachusetts, you know there's a 6.25% sales tax on the goods that we buy, with the exception of clothing and groceries. Excise tax in Massachusetts is based on the fair market value of the property. The easiest one is a vehicle. If you own a vehicle, you receive some sort of excise tax bill from the town or city in which you live in, and you pay that to the town or city in which you live. Now, the rate is typically $25 per $1,000 value of the vehicle, which means it's a 2.5% tax. We have property tax, which is also places a tax on the value of our property. So if you own property in Massachusetts, depending upon what town or city you live in, you will pay property taxes, and that can vary city to city. Okay, so how do we calculate a tax? Well, in order to determine a tax, we need a couple of pieces of information. So we need to know the tax rate, which is usually expressed as a percentage, 5%, 10%, whatever the case is. The tax rate is the level of taxes imposed on the tax base. So for example, here in Massachusetts, we have a sales tax of 6.25%. That's the tax rate. This tax rate is going to be levied on the base, which is the amount of whatever we purchase. So if we put that into an actual formula, if we went and we purchased some goods and we spent $100 here in Massachusetts, with a tax rate of 6.25%, we would pay a tax of $6.25 on that $100. Okay, so when we calculate tax, two things. We need to know the tax rate, and we need to know the tax base. Now, there are different ways to measure tax rates. So now that we have a little bit of an understanding, a very basic understanding of the different taxes, let's look at some ways that we actually measure taxes. And you may have heard some of these terms. We're going to delve a little bit deep into them to see exactly what they mean and how to calculate them. So the first one is the marginal tax rate. This is a tax rate that applies to the next additional increment of a taxpayer's taxable income. In its simplest form, a marginal tax rate is the amount of additional tax you pay for every additional dollar of income you earn. So basically, it's a progressive taxation. You earn more money, you pay more taxes. The average tax rate, this is the taxpayer's average level of taxation on each dollar of taxable income. Again, in its simplest form, a taxpayer's average tax rate is the total tax due, excuse me, the average tax due divided by that taxable income. And we have the effective tax rate. This is the taxpayer's average tax rate of taxation on each dollar of total income, both taxable and non-taxable. In its simplest form, this is the percent of income that an individual pays in taxes. This is basically a person's tax bracket. You might have heard people say, oh, I'm in the 12% tax bracket or the 25% tax bracket. This is what they're talking about. They're talking about the effective tax rate. Okay, let's see how each of these taxes are calculated. We're going to use Jack and Jill. So Jack and Jill have $160,000 of taxable income. They also have an additional $10,000 of non-taxable income. They're going to use the married filing jointly tax rates from the IRS tax table. So we need to determine what is their tax due, what is their average tax rate, and what is their effective tax rate. Also, if they were to receive an additional $80,000 of taxable income, what would be their marginal tax rate on that additional income? So this is the table that the IRS uses to calculate your income taxes. And this table is updated every year. This is the current 2024 table that the IRS is going to use. So when you file your taxes, this is what you'll see. Okay, we're going to get into the calculation now. It's going to be a lot of numbers. I'm going to throw a lot of numbers at you. Don't get scared. Don't freak out. Don't worry about it, right? This is, again, I'm just trying to give you a flavor of what goes on behind the scenes when you do taxes, okay? So as we said, Jack and Jill, their taxable income was $160,000. Now, they did have an additional $10,000 of non-taxable income. And we also wanted to know what the marginal tax rate would be if they received an additional $80,000 of taxable income. So we want to know four items. We want to know the tax that's due. We want to know their average tax rate. We want to know their effective tax rate. And we want to know their marginal tax rate. So we first got to calculate the amount of tax that is due. So if we look at the IRS tax table, we see that their income of $160,000 falls between $94,300 and $201.50. Okay, taxable income is over $94,300, but not over $201.50. And now that we have that, we know that their tax is going to be $10,852. That's a base tax. Okay. And then we're going to add to that 22% of the amount over the lowest amount of 94,300. So what does that look like? Okay. So we have, we got the minimum, the 10,852. Now we need to determine the amount that's over the 94,300. Now we subtract a 94,300 from the 160,000 that they made, and that gives us 65,700. That's the amount over the minimum. So we take that 65,700, multiply it by the 22%, and we get 14,454. So now we add the minimum of the 10,582 and the 14,454, and we get $25,306. That's their income taxes. Okay, so based on their income, they got to pay $25,306. Now we look at their average tax rate, and we said this is the amount of taxes due that's divided by their taxable income. So in this example, we knew that their tax is $25,306. We calculated that. And we're going to divide that by their income, which was $160,000. And that gives us an average tax rate of 15.82%. Okay. Now, if we want to look at their effective tax rate, this is the amount of taxes due divided by all their income, both taxable and non-taxable. Okay. So in this example, we take the 25,306, that's the tax that we calculated. We want to divide that by the 170,000. That was the 160,000 plus the 10,000, and that gives us a 14.89%. Now remember, the effective tax rate tells us the taxpayer's average rate of taxation on each dollar of total income, both taxable and non-taxable. Again, this is their tax bracket, okay? Now the marginal tax rate, this is a little bit more involved, a little bit more complicated. Again, we're going to use the IRS tax table. We're going to use the other one, the yellow shaded one. Okay, we first need to determine the tax due at the higher income. So we said that they had 160,000, and then there was an additional 80,000 that they could earn. Okay, so we got to take that $240,000, and that's going to fall between these two extremes. Okay, so we take that $240,000, and we start with a base of 34,377, and then we're going to add to that 24% of the amount over the 201,050. So if we take our 240 minus our 201,050, that leaves us with 38,950. 38,950 times our 24% gives us $9,348. That $9,348 plus our base of 34,377 that we have 337 that we have to pay. Okay, that gives us 43,685. So what do we do with that? Well, now we have the tax that's due on their regular income, the 25,306, and we also figured out the tax that's due on that additional 80,000 of income. That was 43,685. So we need to subtract those two amounts to get the numerator of 18,739. Okay. Now we subtract the taxable income of 240 and 160 to get our denominator of 80, which would just be the additional income that they were to earn. We divide those two. We divide the 18,379 by the 80,000, and we get a 22.97 marginal tax rate. So remember, keep in mind, the marginal tax rate tells us the tax rate that applies to the next additional increment of a taxpayer's taxable income. Again, in its simplest form, a marginal tax rate is the amount of additional tax you're going to pay for every additional dollar of income you earn. So in this example, Jack and Jill are going to have to pay an additional 22.97% on the extra $80,000 of income. So if they were faced with a situation and they had an opportunity to earn that extra $80,000, they might want to know well, how much tax am I going to have to pay on that? And this is where the marginal tax rate comes into play. And again, I know there was a lot of information there, a lot of numbers, but just, to give you an idea as to what happens, how taxes are calculated. Okay, when we talk about individual income taxes, taxable income, we know that we fill out a Form 1040. So we have a taxable income. We multiply that by our tax rates. That gives us the tax liability. We have some other taxes, gives us the total tax. We have credits, we have prepayments, and that tells us our taxes are due. Now, for those of us who have filed income tax, I just want to switch real quickly and bring in the Form 1040. So the Form 1040 is what we file. This is the federal side. You get your personal information here, your filing status, any dependents, and it's broken down into sections. We have the income section. I'll go over each of these sections in a little bit more detail. We have the income, then you have tax and credits, so any taxes or credits that you're eligible for, and then any payments that you made, and then you end up with either a refund or amount that you owe. So that's basically the Form 1040. Now, the Form 1040, all the information on the Form 1040 comes from supporting schedules. So all the figures on your Form 1040, there's going to be some other form that will be behind the 1040 to support the numbers that you reported. Okay, so let's delve a little bit into the Form 1040. So the Form 1040, this is the federal tax form that we use for our income taxes. Again, the first section of this form contains all the different types of income. We'll have income from wages, income from tips, dividends, any IRS distributions, any Social Security benefits, any capital gains. And again, the IRS wants to know the amount of your income from all activities, all income earned, even your illegal activities. Okay. Now the income is totaled. The income is totaled on line 9 of the Form 1040. So line 9 will have your total income. And depending upon your filing status, which is here, okay, the IRS allows us a standard deduction depending upon our filing status. This year for 2024, it's $14,600 if you're single or married filing separately. It's $29,200 if you're married filing jointly or a qualifying surviving spouse. And it's $21,900 for head of household. Now, the IRS allows these taxpayers to deduct the standard deduction from your total income. And the standard deduction, what that does is that reduces the amount of your income that is going to be taxed. So this will provide the taxpayer with that taxable income. So the IRS gives us a couple of options. Okay, we can take the standard deduction, or we can fill out a form Schedule A. Okay, I'm going to bring that in. Okay, we can fill out the form Schedule A, and if all our deductions on the Schedule A is greater than the standard deduction, then we would want to take our itemized deductions because that will lower our income. So what exactly is the Schedule A? Schedule A is the holy grail of your tax form, because this is where you can put a lot of information to really reduce your taxable income. So the first part is our medical and dental expenses. So if you pay any this includes insurance. You pay for health insurance, you pay for dental insurance, mileage that you drive to and from the doctors, eyeglasses, hearing aids, any type of medical devices, any cost that you spend for medical and dental goes here. Okay. Now the caveat here, remember we talked about a threshold has to be met in order to a deduction or a credit to kick in. This is one of them. So your medical expenses have to exceed 7.5%. Okay. Any dollar amount you spend over 7.5% of your adjusted gross income can be used as a deduction. So for example, if your adjusted gross income, whatever the dollar amount is, and 7.5% of that was $5,000. If your medical expenses were $5,001, you would be able to claim $1 in medical and dental expenses. Okay, because you've hit the threshold, you've exceeded that 7.5%. Okay. The other section is any state and local taxes, real estate taxes paid, personal property tax. This is where your excise tax would go. Right now, years ago, there was no limit on this section. Okay. About what are we talking? Maybe 7 years ago, they changed this. It's now capped at $10,000, $5,000 if married filing separately. Now, this hurts people who are in a high municipality where their real estate taxes would be high. Think of like $1 million house, say, or even in Boston. You're living in Boston, you got $1 million property. Think of what your real estate taxes would be. The IRS says whatever these dollar amounts add up to, you can only take $10,000. That's it. You're capped. Okay, this hurt a lot of people when they changed that tax law. Okay, the next section is interest you pay. This is home mortgage interest. You have a mortgage, you pay interest on that mortgage. This is where it's going to go. Any points that you pay. So this is, again, this is why this is the Holy Grail, because you can really put a lot of information on this form. And then we have gifts to charity. Okay, you can donate money. If you donate any more than $250 or more, that's in a single donation, you got to fill out a different form. Okay, if you make multiple donations, small dollar amounts, and they total more than $250, you're okay. You can also donate any types of goods, clothing, furniture, household goods, whatever the case is. Okay, again, if any of it is more than $250, okay, you're going to have to submit a form. And if it's over 500, you got to submit a form 8283. Now, if you happen to hit a threshold where you're not allowed the deduction for the charity, you can have a carryover from prior year. That means if you have too much money that you donated that you can't use in 1 year, you can carry it forward to the next year. And then casualty and theft losses, this is just if you have, the easiest thing is if your house was damaged, you submitted the claim, the insurance covered only a portion of it, you had to pay the rest out of pocket, this is where that would go. And then any other itemized deductions. So your itemized deductions here, as long as they are greater than your standard deduction, you would want to go with the itemized deduction. Okay, and that will help lower your taxable income. All right. So Schedule 1, this is another schedule. I've taken a portion of it here. For you guys that are students, this is where your student loan interest deduction is going to go. So if you pay student loan interest, right? We all have student loans, we're paying on them. You'll get a form from your lender, from your loan provider, and that will tell you what your interest that you paid on your student loans. It goes on Schedule 1, line 21 of Schedule 1. Now, the maximum deduction for student loan interest is $2,500 per year. So if you pay more than $2,500 in student loan interest, you can only claim the $2,500. Again, remember we talked about thresholds and limits? You can take this deduction if your modified adjusted gross income is $75,000 or less. If your filing status is single, it'd be $155,000 if filing jointly. So if you don't meet that threshold, you can take the $2,500. This $2,500 will go to Form 1040, Form 1040, line number 10. Okay, you'll see, let me see if I can bring that back in. I can get it to go. Okay, hook on my, okay, here we go. Hold on. Technically challenged here. Why can I not? Oh, here we go. Okay. So this would go on line 10. Okay, so your Schedule 1, you're going to have your student loan interest, and then it would also flow over to the 1040. So again, remember I said the 1040 has all the information, but then there's supporting documentation that the forms will come. Schedule 1 is one of those supporting documents. Okay. The next part is the taxes and credit section. So this is the next section of the 1040. This is for any taxes and credits. So from the IRS tax table, we need to determine our tax. So we go to the IRS tax table, we figure out based on our income, what our tax obligation is, what our tax liability is. And once we find that, the next couple of lines, if we have any type of credits, those go there. And then we come up with our total tax on line 24. The next section is our payment section. So section includes the amount of tax that was already withheld from my paycheck. So you worked all year, you get your form W-2, you have your federal income tax withheld, that shows up on line 25A. Then if you have any other tax withheld from any other forms, Form 1099, any other obligations, they would be added. And then we have our total. So if you've paid estimated taxes, like throughout the year, if you paid quarterly taxes, or if in past years you had a large tax obligation so that you paid a little bit, that would also go in this section as well. This section also includes credits, a tax credit for any child tax credit, and also an education credit. There's two. There's the American Opportunity Credit, and there's the Hope and Learning Credit. Okay, so as a student, you may be eligible for one of those two education credits, and that's where it goes here. It'll go on this section of the Form 1040. Now, line 33 provides the taxpayer with the total amount of payments made toward that tax. So we already figured out our tax liability. We've got that determined. Now we have some payments and credits that we made. Now we're going to look at what the difference is between those two sections. Okay, so the final section of the Form 1040 tells us any amount that was either overpaid toward our tax liability. So any excess amount that was overpaid is returned to us as a refund. And who doesn't love a refund? We love our refunds, right? Now, if as a taxpayer, you did not withhold enough from your paycheck, that deficit must be paid by the taxpayer. Everybody loves a refund. I have never met a person who said, dang, I'm getting a refund, right? Who was upset that they got a refund. Everybody loves a refund. A lot of people enjoy that large refund because they tend to do something with it. And you may fall into this category. Okay, great. I got a great refund. I'm going to pay for a trip, or I'm going to buy furniture, down payment for a vehicle, whatever the case is. Okay. And that's fine. That is totally okay. There's nothing wrong with that. But I want to make you aware that that refund was your money to begin with. The government doesn't owe you that. That was money the government took out of your pay, and they just took too much. That's your earned money. Okay, that's extra money that you loaned to the government, interest-free. You gave the United States government an interest-free loan for them to do whatever they want to do with it. And then at the end of the year, they gave you back the excess. And I tell people, give me your money, interest-free, and at the end of the year, I will give it back to you. Because what I'll do is I'll invest it and I'll earn interest. And then at the end of the year, I'll give you back your money. Now, isn't that a great deal? That's a great deal, right? So if you structure your withholdings correctly, you can result in you receiving that refund, which again is money that's your money to begin with. You can structure it so you get it in your weekly paycheck instead of waiting until you file your taxes. Again, I have tax clients that love the big refund. They're not good savers. So they love that $1,000 refund because they always use it for something that they've planned throughout the year. Again, vacation, home repair, down payment on a vehicle, something. And that is okay. All right. My philosophy is, why should I give the government an interest-free loan when I can get that money in my paycheck every pay period and use it for what I need it for? Okay. Now, I structure my tax situation where I owe the government every year, and it's a small amount, usually under $500-600. That's because I want my money. I work hard for my money, and I want it. I don't want the government. I'm not giving the government an interest-free loan. In the past, yes, I loved it. I wasn't a saver. If I earned $1, I was spending 10, right? So I was like, okay, I need that refund at the end of the year. Right? And I got a credit card bill I got to pay, whatever the case is. Then I got a little smart. I said, you know what? This is crazy because I can invest that money and I can earn some interest and I can still have my refund, so to speak, at the end of the year and pay whatever I need to pay. So again, there's no right or wrong. If you're one of these people that love to get a large refund, awesome. Take that refund, take a nice trip somewhere, enjoy yourself, have fun, sit on the beach, drink margaritas, whatever the case is. All right. If you're like me, I like to have my money every pay period. I structure it so I don't pay the government. All right. So that's basically income taxes in a nutshell. Again, I know it was a ton of information, a lot of calculations, a lot of things that we went over. But are there any questions on any of the sections, any of the information, the supporting documents, the forms, anything that you may have? I know someone's got a question. They're just afraid to ask it.
Um, so I have a question.
I have an answer, but you have to go first.
Okay. So I like to know if you're using
You're muted.
so I'm asking if you're using your advance tax credit to pay for your mass health, um, would you have to report that in the 1040 filing?
Tell me that question again. What are you using?
Advanced premium tax credits to pay for mass health?
So okay, so you're on Mass Health, the state gives you some funds to pay for Mass Health, right?
Yeah.
No, okay, so your question is what?
Yeah, my question is, do I have to file for this or state it in the 1040 that I'm receiving
No, what will
these
happen is
credits?
you should have received a form. I forget what the form number is, and it will show what what that payment is for what that credit is for Mass Health. And that is going to be when you go through the tax form, when you get to the health section. Now, years ago, for the federal side, if you did not have health insurance for, I believe it was at least 7 months out of the 12 months, you were penalized. And it was a significant amount of money. They did away with that on the federal side. On the federal side, if you don't have health insurance on the federal side, there is no penalty. They eliminated that. But on the state side, here in Massachusetts, if you do not have health insurance for a majority of the year, there is a significant penalty. So that's where those figures would go in. You'd say that on the mass side, you'd say you have health insurance. You'd say what month you have it for. You'd put in the amounts. You're probably getting the same amount, standard amount each month towards the health insurance. That's where that would go. And then what the state does is they say, okay, based on your income, because that's a look back. That's what we call a look back credit. What they do is they're going to look at your income for 2023 and give you a credit for 2024. Now, in 2024, when you file your taxes, they're going to say, okay, this is your income in 2024. This is the credit we gave you towards health insurance. We gave you too much because you earned more in 2024. You have to pay some of it back. Or the flip side of that could happen. Okay, you didn't earn enough in 2024. We didn't give you enough of a credit, so we're going to give you more.
Okay.
Okay. So that, yes, that would have to be, again, your tax preparer will take that information. And again, that's a look back process. They'll look at because it's they're giving you that credit based on your 2023 income to say, this is what you made. So this is what we're going to give you for a credit to help offset your health insurance costs. Now in 2024, they're going to look and say, well, all of 2024, you were working, you made all this money, we gave you this credit. We either gave you too much or too little, and we're going to reconcile that. And then you're going to have to either pay some of it back or you're going to get more, depending on your individual tax situation.
Okay.
Okay. Great question. Really good question.
Thank you.
What else?
Okay, so my question pertains to non-residents, international students. Now, when it I want to understand which taxes apply to us international students. For example, if you received a scholarship from your home country, is that taxed? And then if probably you received an on-campus job, could you help explain with an example how an international student could maybe file taxes if that is not a stretch? So
Okay,
to
so
help stand
okay,
out,
so
yeah.
I'm hearing a couple of things there. It sounded like I heard you got a scholarship from your home country. Is that what I heard?
So assuming someone is being funded by their home country.
Okay. I do not believe scholarships from a home country would be included in anything. That would come up on the when you file your tax return, there's a form that you'll fill out for the education portion to figure out if you get any type of education credit. That's where that would come into play because they're going to ask you. Matter of fact, from Bridgewater, you should get a 1098-T, a form 1098-T, which would show the tuition that you paid and any scholarships that the institution provided you. When you fill out your tax return, there's going to be a portion. When you do that education section, it's going to say, okay, how much did you pay for tuition? What was the tuition amount? Did you get any scholarships? What was the cost for books, lab fees, any of that stuff? Then there's also going to be a question there about, did you receive any other funding from any other source? Friends, family, whatever. That's where that scholarship from outside would come in. And then they're going to see exactly what your obligation was for tuition, because you may have paid zero, right? The institution may have charged you 30,000, but between scholarships and funds that friends gave you or your home country gave you, it might equal the 30,000, which means there was really no cost to you. Okay, and then that would negate any credit. So I think that was one question. What was the other question you had about work study? Is that what I heard?
Yeah. So with the other question, I wanted you to like give an example, like using an international student to just help me get how an international student will file their tax and
Yeah, so
return.
an international student would have to file both if they worked, if they earned income. If they did not earn income, then they do not file a tax return. This is only if they earned income. So if they had a job off campus, part-time job, full-time job, doesn't matter. If they worked on campus and actually got paid, again, the school would issue you a W-2. Okay, either way you work, you're gonna get a W-2. And you would take that. Now, what you do, you're international student, you would fill out the form 1040, depending upon how much money you earn, because there is a threshold. If you make, I apologize, I don't know what the dollar amount is. I think it's somewhere around 6,000 or 7,000. If you didn't earn more than that amount, you do not need to file a tax return. Okay, but here's the caveat to that. If you earned that amount, even if you earned $4,000 and you had taxes taken out, which if you work, they're going to withhold federal taxes, then it's in your best interest to file a tax return because you'll get all that back. Remember, we talked about the standard deduction, right?
Yeah.
So if you made $4,000 and you had $300 withheld in federal taxes, you're filing single, you earned $5,000, you get to reduce that $5,000 by $14,600. That means you have zero taxable income, which means you're going to get back all the federal taxes that was withheld. So it's in your best interest to file that 1040. Now, on the state side, what you would do is you would file a Massachusetts state tax return, but it'd be Form NR, which is non-resident, because you're not a resident of the state of Massachusetts. And if you were just a resident, you just file a regular Massachusetts state tax return. And again, if you worked, you're probably going to have state taxes withheld, which means it's in your best interest to file that tax return so you get all the federal money, all the state money that was held. And I believe the state gives you a standard deduction of $4,400 or $4,600, somewhere in that dollar range. So again, in your best interest to file.
So I have a final question. When I was filling my forms, right, now there's the expectation of a scholarship, but at the moment, it's not been applied yet or it has not been received. So the income stated on the form is higher than what I might actually earn this year. So in that case, if I file a tax return and they realize what I did and what I earned did not match what I expected to earn, would they still return the deductions?
So I just want to make sure I understand the question. So you
Let's say,
received,
assuming I was expecting a scholarship of about $30,000, but then it couldn't arrive in time.
okay,
So the only thing I earned, or the only thing I like reported from everything I did in the US, was about $8,000, right? So it did not match what I expected to earn this year, but they asked me my expectations. So with that $8,000 earned or reported as my end income for the year, would they use that to return my taxes paid, or would they still go by the 30,000 I initially said I was going to earn, even though that had not yet arrived?
okay, so you're supposed to get $50,000 scholarship that did not arrive in
Yeah,
time,
yeah,
but you have $8,000 that,
yeah, and from an on-campus job. So
okay,
with that,
so $8,000 of income
yeah,
that you earn, that's from a job?
yeah,
Yeah, so that $8,000 would be included in income. But let me go back to the scholarship money that did not arrive in time.
mhm.
Uh, I don't need to know the answer to this. I'm just going to give you some information. When you say it did not arrive in time, did it arrive in 2024? So for example, the semester started September of 2024, okay? And bills are due, so forth and so on. If the scholarship money didn't arrive until, let's say, November of 2024, okay, that's
Yeah.
very different than if the scholarship money didn't arrive until January of 2025. Because now you're covering two different tax years. You got 2024, 2025. So it's going to make a difference. And again, that would be when you fill out the education portion of the tax return, that's where that's going to come into play. Because there is a section there that says, did you receive some money in a prior year for the current year?
Okay,
So again, there's all, so when you say it didn't arrive in time, it's all about dates. When did the money actually arrive? For what educational year, academic year was it should have been applied to, so forth and so on. Okay.
okay. So to be direct, right? It was supposed to. I arrived this spring, so it was supposed to apply from this spring, but then
Spring of
for
2025.
yeah, spring of 2025.
Okay.
And when I got an on-campus job in filling the reports, I gave an estimate of what I could earn, adding that scholarship. But it seems it would arrive probably by summer or fall. So in this instance, even though I'd already written there that I was expecting maybe $30,000 because that was the expectation, and that did not happen. Based on how much I've been taxed already from my job, would they use that? That is what I want to understand. Would they only use what I've earned so far? Because I've read a deadline is April 14th, right, for this year.
April 15th.
April 15th, sorry. So that was what I was asking.
So we're talking about all this occurred in 2025.
Yeah.
Okay. You do not have to worry about it
Okay.
this year. That will
Okay.
all come into play in 2026 when you file your 2025 taxes.
Okay.
So just keep all that information. Okay.
All right.
So for 2024, they just want to know what happened in 2024. Our tax system here, again, it's a look back. Okay. We work all year, we do everything in 2024, and then it's not until 2025 that we reconcile that, we give all our information to the government, and then we decide whether we owe more or we get a refund. So
Okay.
for your situation, for that situation there, that's all occurring in 2025 and has no bearing on your 2024 income taxes.
Okay. Thank
That
you.
will come into play in 2026 when you file your 2025 taxes.
Okay. So
And at that time, it could be a completely different tax situation. It could have completely different impact on you because the tax codes could change.
okay. So based on that information, it means I don't have to file any taxes this at this current time because I wasn't here for 2024.
If you were not here in 2024, you are good to go.
Okay.
You
Thank
just
you.
cruise through life and enjoy yourself. But don't leave. I'm gonna give you this. I'm gonna give you this little tidbit of information.
Right.
Don't leave the United States, okay, permanently without filing taxes for 2025. Because I
Okay.
will tell you, I've run into this with people. I've had people who have come to the United States, and worked, right? School, whatever the case is, left for a long time, 10, 15 years, and come back to the United States. As soon as you come back to the United States, that Social Security number, and with the advent of computers, there's no hiding. The government has a very, very long memory. And as soon as you come back and you start a job, you put that Social Security in, bang, they got you. They're going to say, this person worked, our records show that this person worked in 2025 and never paid income taxes. Now here it is 2035 or 2040, and you're going to get a letter. You're going to get a letter from the IRS saying, hey, you never filed taxes in 2020, 2025. What's going on? And they'll figure it out for you, and they will just start garnishing your wages. I've seen it happen. I'm being upfront with you. I've seen it happen. Do not leave this country. Even if you live in this country, always pay your taxes. The government has an extremely long memory. Computers, that information will sit in there for years. And as soon as you do anything, you apply for a loan, apply for a credit card, register to vote, anything, it pops and you'll get a letter from the IRS. And you don't want the IRS chasing you. You just trust me, you do not want that happening. I don't want to scare you. Just telling you the reality. Okay?
Yeah. Thank you.
All right. Any other questions?
Yes, so I have one more question. So what if you worked from 24, that's September 24 to December? And also my question is, do we have to state, let's say if you paid fees that you invested in and you paid insurance fees. I know you said with the health insurance we have to put it under the health line, but with let's say I paid school fees for spring 24, do I also have to state that in the 1040?
Yeah, that would come. So I want to make sure I understand the question. So we're talking you worked from September to December of 2024?
Yeah.
Okay. So yes, that income, whatever you earned in that income, again, whether it's legally, illegally, you should report it. Okay. Especially if you had taxes withheld, because you'll get that back, most likely, in all likelihood. Now, as far as the fees, yes, that all comes under the education portion. So anything you paid for tuition, anything you paid for fees, anything you paid for books, lab fees. I don't know, does Bridgewater charge if you play a sport? I don't know if they do anything like that. So any cost to attend college would fall under that education portion. Okay, now as far as the insurance, so I'm assuming you purchased the school's health insurance.
Yeah, the Blue Cross.
That would go
Blue
under
CPS.
the insurance on the Schedule A, but I'm gonna tell you that you will not use the Schedule A. Okay, that's going to go here on the Schedule A. Now remember what I said. The total of everything on the Schedule A, as long as it exceeds the standard deduction of 14.6, you should take the itemized deductions. So there's two things going on with that insurance. First of all, it's got to be greater than 7.5% of your adjusted gross income. So whatever that is, okay? If your adjusted gross income is $10,000, right, then 7.5% would be what? $750? Did you pay more than $750 in insurance? If you paid $751, you get $1. You get to deduct $1. Not the 750, one. You get one single dollar. Now, is that $1 greater than your standard deduction of 14,600? And the answer is no. So you're probably not going to have to worry about the Schedule A. The Schedule A comes into play if you have investments, if you have a home, if you have,
Also, what if you, as an international student, you invest in stocks, but so far you haven't made an interest yet for the fiscal year?
okay, again, that's a timing thing. Did you invest in stocks in 2024?
Yeah, and
Okay,
from
so there's two
September.
things, okay? Are we talking actual stocks where you buy stocks and then you sell the stocks? So you have either a gain or a loss, a capital gain or loss, or you're talking about you invest in a mutual fund or something like that where they're
No,
doing all the.
actual stocks.
Okay,
Like,
so if you purchase stocks and you have not sold anything yet, you haven't done anything yet, you have no realized capital gain or loss. However, you may have received, and again, I don't need to know the answer to this, you may have received a 1099 div, or a 1099 int, okay? And that would be interest or dividends, because stocks pay dividends. So if the stocks pay dividends, you're going to get a 1099 div. That goes on, that's part of your income. That's taxable income, okay? Once you sell the stocks, now you're going to have either a gain or a loss. If you bought the stocks for $100 a share and you sold them for 150, you have a $50 gain. That's a whole different form.
yeah, well, how the market is going, it's looking like a loss. So what do I do
Okay,
if I
again,
had a
so if you have a
loss?
loss, right? If you have a loss, that goes on the same form. That would be the schedule, I think Schedule B or Schedule D, I forget what schedule. Okay, so that
Okay.
loss would go on that schedule, and that would come over to your to the income section of, that would be right here. Capital gains and losses, Schedule D. Okay,
Okay.
that would come right here. So that would reduce any losses, would reduce some of your taxable income.
Okay. Okay. Thank you so much,
Right.
sir.
Thank you so much, Professor, for your time and for such an informative presentation. I think we had like a good bunch of questions, and thank you for your answers to those as well. Yeah, we're so glad to have you, and I think we would look forward to, if there's any other questions that anyone else had, we could probably have them send it to us, and then we could communicate with you and get on those. But I think for now, I would just want to thank you so much for your time, and yeah, see you next year, hopefully.
Yeah, well, I think this is my third. I don't know how many years I've done it.
Probably, yeah.
They keep asking me, and I keep saying yes. But like I said, I'm a double alum of Bridgewater. I love the institution. It's opened up so many doors to me professionally. I owe a lot to the institution. It's a great, great, great institution. And I enjoy teaching there. I enjoy doing these seminars, because I think it's just knowledge. Hey, that's why we're in college, right? Knowledge is power, right? Knowledge
So
is
true.
power. The more knowledge we have, the more power we have. That's just my personal opinion. The more you know, the better able you are to take care of things. So it's my pleasure. Thank you. I'm glad that you guys invite me every year. Apparently, I'm doing
Of
something right.
course. Of course, we're more than grateful for your time and efforts and all the information that you put together for us.
Yeah,
So
you
thank
haven't kicked
you.
me out yet. But yeah. So
Thank
thank you. I
you
appreciate
so
it. Thank you very
much.
much. You're very
Of
welcome.
course, of course. I'll stop recording now, and